Welcome everyone to the Market Profile Mastery Series, Course 2. It's Friday, July 14th, 2017, and we're at high noon Eastern Time. This was initially going to be our weekly webinar with Peter Resnicek at Shadow Trader. We've switched it up through a scheduling conflict with Peter, and we have made this a market update webinar with the question and answer. So next Friday at high noon, Peter will be back, and for the remaining Fridays, but for this week, we're taking it as it comes. So thank you for being here. Great to see you all back. And please put your questions in as you have them, and I will turn it over to Jim. Hi, Jim.
Well, hi. Well, we'll start off with a bit of trivia. When Julia said high noon, with my last name being Dalton and there being a Dalton gang, which we honestly don't know if we're related or not. My dad said we were, but we never actually traced it to see. But it's always been an interest, the cowboy stuff. But we say high noon. We were down in Tucson one time, and they had, not Tucson, Tombstone. And they had all the fake stagecoaches running around and shootouts. I can only find one recorded shootout at high noon, face to face in the streets, even though that's all the movies portray. Most of the killings took place from behind corners, from rooftops, etc. Anyhow, trivia is over. Let's go back to the market. If anybody was following my worthless trade, I covered the short on the break, made a whole 75 cents or $37 on it, so left me just with the 24.50 calls and the 24.40 puts. Now I did add to that 324.45 puts for $30 a piece, just in case the market did break. Anyhow, enough of that. The most important thing, as I was thinking about this, the single most important thing I think you can all take away from the second session of the Masteries series is this idea of chunking. I mean, I know I've said it a lot of times, but my guess is that a lot of people hear it, but a lot of people don't work on, it's one of those things I'll take a note and they roll on. But if you can see almost every day this week, that has been valuable information, and it's not one piece of information. When when you back your car out of the garage, you're not looking at one thing, you're looking at several things at one time. Your speed, your gear, is the garage door open? Can you see in back of you? Is there anybody walking back of you? You're looking at all that kind of thing. And it's the same thing here this morning. Again, I know I'm repeating myself, but you saw this morning, we made some early observations. We made them fairly quickly, and they were very beneficial. We said the early high was questionable for a couple of reasons. We looked back down. They said the tempo on the downside, was relatively slow, but the fact that it was so exacting from where the high was, this is probably, for the first thing, if you're chunking that information, the first thing it does, it keeps you out of a bad trade. Julia said it the other day, very, very important to learn. Most people focus on return. If you will change your focus from return to risk, I think it will make a huge difference in your performance. Remember, most people are focusing on return, and if people say, well, how are you going to do in the course? I said, well, we're going to really focus on teaching you how to evaluate risk. And say, well, what about return? And we stay to the risk. I think you'll find it is important. So what did it tell me this morning? It told me I didn't want to be short. gave me an indication I might want to be long with the trend, but it told me, one, I didn't want to be short. So it kept me out of a short trade. It wouldn't even go through my mind. Same thing happened yesterday. The market kept me out of a trade. Now, then the market broke, and the B period came exactly down to yesterday's high. We said that is questionable. It's a very mechanical thing. We talked about fast trades. Somebody asked about fast trades. Said that's fine. But when I looked and recorded that, I said that's really takes away from the confidence to the upside, because that's a very questionable mechanical low. D period broke, and guess what? It stopped again a couple of ticks above yesterday's high. Who was doing the buying? It's the laggard momentum buyers. I put out on the chat, laggard momentum buyers are getting longer and longer. Now, does that mean it's going to go down? No. But what it does mean, it means that the risk of being long is higher. You talked about it. How do you know if inventory is too long or too short? Well, not only do you want to know if it's too long or too short, you want to know who's holding that inventory. When the market is bought exactly at yesterday's high, who do you think that is? One, it's not the strong traders. The strong traders are going to trade in larger size. They can't wait for an exact number. So you can know that it's not them. It's weaker momentum traders. Okay, now that doesn't mean the market's not going to go up, but it's when you're calculating and thinking about risk, it tells you that they're not the strongest people that are owning the market. D period breaks a couple ticks off of the early morning high, or off of yesterday's high. Again, it's more momentum traders. So they bought it here, and so far, they're a little bit ahead. Now you sit there and say, yeah, but the high is no good, Jim. Aren't we going to take that high out? I don't know. In a market like this, I don't want to be long. I don't want to be short. Unfortunately, I am with the straddle and strangle. And sometimes that's the worst thing for one of those things, is taking away volatility. The high is at 24.50.25. I suspect that the option traders are doing everything they can do to hold, fix, or rivet the price at the 24.50 level. Can I prove that? No. Do I suspect that? Yes. It's, I don't know what's, and can anybody look and tell me what the open interest is at the 24.50 on the options and the futures options? Somebody take a look out there and give me that back if you know how to do that. So anyhow, that's what I think is going on. There is no trade. There is no trade in here. In this narrow range, it's getting quieter and quieter. You had a chance. They bought it in D. You look like, whoa, they're going to go. And they stopped on a dime. E was an inside bar. F is opening within E period. The market's getting tighter and tighter in a very narrow range. So there's not a lot I can tell you other than, one, this market has kept me out of trades, even though I did one last night, but it's not a lot of money, and it's actually not working out very well. But this morning, it's kept me out. I haven't wanted to be short. I haven't wanted to be long. Okay. Any question is fair for this period. Julia, please. Julia, are you on mute?
Oh, I was off mute and I hit mute to talk. The 24.50 calls, open interest is 6,858. The 40 puts, open interest 61.87.
Is that 6,000 doesn't sound very high. On a relative basis, does that look high with what's around it?
On a relative basis, Mark, what do you got to say? Yes, it's high. Well, I said okay. Yes. I assume you said asking if it's high.
Yeah. So I mean, you just I mean, if there's nothing else going on, it's always amazing how these traders can kind of fix this to a market. But if you go back and you look at the history of Fridays, you will see it's not uncommon for them to keep the markets in these very quiet range. But the other thing you'll see is when they can't do it, you normally get a trend day, and you get a trend day that really hurts these option traders. They are scrambling all day to cover their positions. So you normally, if you look at Fridays, you either get a relatively very narrow day like we're getting today, they could control the market, or you'll see trend days a lot of times. And the reason the trend days they could cause because they get hurt and the markets start to move. They're selling this premium and getting nickels and dimes for it. The markets start to move. Their fear is we're going to take it away from them, in $5 and $10 bills. And so that causes them to come in and either buy or sell futures, because a lot of times they can't get the options in the size that they need. So they have to either buy or sell futures. Okay, thank you, Mark. Additional questions?
Yes, how do options traders fix price there when the market is buying 2450 calls? Market makers sell the other side there, building volume there? He's trying to understand the mechanics.
Yeah, I don't know all the mechanics anymore. I used to know that stuff pretty well, but they'll try and buy and sell just to keep it riveted there. And I don't know all the mechanics, but that's what they try and do. And we've seen this for many years. And it used to be that a lot of the people making markets and options were small traders, people on the floor, small traders off the floor. What happened is most of the small option buyers and sellers, buying and selling premium, most of those got burnt out of the business just because of the volatility. So the business has been taken over by very large firms that do it in very large size. And they've got, these very sophisticated models and everything else. So, but most of the small traders are out of that business. Option selling naked premium, in my opinion, is the worst strategy out there. I would never do it. I tell people anytime I get a chance not to do it. You make money a very high percentage of the time. However, when it's taken away from you, it's taken away in huge chunks. And that's where, that's what misleads people. They get into it because they'll say, oh, this works all the way. I've been doing this for some period of time and look at all I've made. And I said, well, we'll see someday. And it happens so many times. The story I tell of my friend that went $10 million debit, on basically the 87 crash. And I was trying to tell him, the risk. He was the second largest trader on the CBOE floor. And he was trying to unwind, but his positions were so big. But that's what happens. Of course, he wouldn't sell premium anymore. He stayed around, paid it all back. But he does a whole different type of trading these days. Okay, other questions? I'm sorry, that's not a complete answer to your question because I don't know all the specifics. In order to understand all the nuances, you have to be involved in it. But generally, they're larger firms, and they're trying to play mathematical games and trying to sell it to the buy and sell in order to kind of keep it to that price. And if there's nobody around to disturb them, they get away with it. And there's a lot of them the same way in the market. It's not like you have 50% did this and 50% did that. More of the public is a buyer, more of the professionals are sellers, and they're large firms anymore. Okay.
Okay. The D low is one tick over the weekly high. I don't know if you have any comment for him.
Not really. I mean, it's clearly it's at the it's, it's at the 47 level. It's the weekly high. It's, yesterday's high. It's just a very mechanical level in here. No, I'm aware of it, but I think the whole thing is that this started with the B period low, the D period low. In my opinion, both of them are questionable.
Okay.
Okay.
Yep. In regards to today's market, can you talk about the ambiguity of how time spent above the overnight high is bullish for the market, but too much time spent there without the market elongating is bearish for the market?
Yeah, I mean, the more time it spends up here, you're accumulating more longs, just like you got the longs in B period, you got the longs in D period. And, the more it stays up here and doesn't, go up and take the all-time high, the more nervousness it builds up on the longs. Let's go back, and just the same thing. I've shown this example before. It's the same thing as yesterday. The market spent so much time up here, they didn't get a carry through. You got a liquidation. When it first went up here and you got a poor high, it's bullish. And the longer it spends there and they're not getting satisfaction, then the chances of liquidation are great. The difference is when you look at these things, and this is where people get confused. The difference is if you get the liquidation, they tend sometimes to confuse that liquidation. I'm going to go back to yesterday for a second. The tendency is to confuse this liquidation, which is nothing but an adjustment of inventory that got too long, with an idea that there's more serious, longer-term money in the market, because they see price going down. And that's what causes a lot of problems, because then they end up getting long. If you are getting short, but if you understand what this is, and understand this is just liquidation of short-term inventory versus something far more potent, which would be liquidation of short-term inventory and new money selling in the market. And if you've got new money to sell, it's unlikely it's going to sit here for an hour and a half. When this happens, the odds are it's just liquidation of short-term money, short-term positions, which it did. It broke, and it's back up here, and then we're higher today. So learning to differentiate between liquidation and real serious selling in the market. I mean, real serious selling isn't going to come from here. I mean, it could, but normally it's not. And this is more liquidation. If all of a sudden you open in the morning and you start trading higher or lower and you're getting pretty good volume, now you may have more than daytime frame, activity. You may have longer term participants in the marketplace. Keep in mind, it's not a black and white thing. You have the two extremes are those people that buy and hold on one side, and the very short-term traders on the other side. And now the short-term traders, there's two categories of them. There's more than that, but I'll simplify it. You got the daytime frame traders, which we've talked about. They generally come in flat, have to go home flat. Now you've got those traders that can hold positions overnight and a few days at a time, and some of these traders are very, very largely capitalized in the billions of dollars. And now they can make it look like institutional money on the sell side because of their size. But generally when they come in, they have a tendency to butcher a market. They come in, all or nothing, whole hog, and the market will run like crazy. Long-term money generally doesn't do that. They don't butcher a market. They come in, they buy a little bit, they let it go down, they buy a little bit more. It's just more of control. But the main thing is you're looking right here, and the value of the profile, when I look at this, remember we organize the data in order to get a better view or perspective. When I organize this data, I can see the inventories building. I'm expecting this. We get the liquidation break. That's all there was to it. It was not a combination of even the second tier of short-term trading or longer-term money. Anyhow, it's just an extremely important concept to understand in the marketplace. And when you look this morning, there's no long-term buyers, there's no long-term sellers in here. This is all trading money, and more than likely momentum money. And people that just think it's easy. Oh, we're going for the all-time high. They've got themselves focused on that. And the risk reward for most of those traders isn't worth it, even if they get it right. Remember my analogy of momentum traders. You can go to the racetrack, and instead of placing your bet before the horses leave the finish line, they can place a bet all the way until the horse crosses the finish line. Their odds of winning will be good, but when they lose, it'll be huge. You know, a horse breaks its leg 5 foot from the finish line, that's very expensive. But it's the payoff isn't there. But that's kind of what happens. And I think when all these people this morning, I mean, they're bound and determined to take that. They're feeling very comfortable, very secure going after that high. The sellers aren't interested. They can see what's going on. They'll play wait and see. The institutional traders will do something, or, you know, markets will do something, and I love it. Well, you know, we're not selling here, but we're standing in the doorway. I've heard them say that many times, and I laugh because if all hell breaks loose and they're all in the doorway, they're not going to get through the door at the same time. You know what's going to happen. You know, they'll all of a sudden turn to get through the door, and they'll run into each other. The shoulders won't be wide enough. And that's what happens. So sometimes when it does start, we get some massive liquidation breaks that feeds on itself. But for right now, the risk of being long this morning certainly isn't worth it. Even if they get this high out, it's just a bad odds play. Okay, other questions?
Over Jim's decades of experience, has he always seen these exacting Momo traders, or has this begun in recent years?
No, I think I've always seen them in there. I mean, sometimes there's different forms of them, and it's not as exacting as you're seeing here recently. Just because there's so much little activity in the market, slow motion, and we can see it and dissect it, which makes it really nice. Sometimes it happens much faster when the markets have more volatility, but I've always seen them. And the reason is momentum trading is the easiest type of trading to do. It's the easiest type of trading to do. They do mathematical models. They do what are those kind of things? I'm trying to think of all the terms. But the momentum models and all of that kind of stuff. But it's also the easiest to get in trouble with. The fact that it's easiest to do makes it the easiest to get in trouble with. And particularly just the nature of traders and people is, and we break it down in the diffusion model to, early adopters, or innovators, early adopters, early majority, late majority, and laggards. That holds true for day traders, multi-day traders, long-term investors. That kind of thing happens. So if you think about that, when people come into the market, if you're early in the start of a trend, whether it be a day trend or whether it be a longer-term trend, the momentum traders are going to do fine. You'll get your innovators, and you get your early adopters, start to feed on itself. The most recognizable place will be the early majority and then the late majority. It'll be fairly easily identifiable. You don't want to fight it because there's a lot of people trading that way, and they'll feed on each other. It's when it gets late in this, and then you say, okay, whether it's a day trade or whether it's longer term, when it gets late, it gets harder and harder. It gets harder and harder to make money, but usually these laggard traders, think it's easy because they've watched it for so long. I used to use the example before we broke it down into the diffusion model. I used the example of if I gave 5 people a perfect trade, and I could promise them a win. Those 5 people wouldn't enter the order at the same time. You would have some people do it right away, and the other 4 would all watch it more and more, to get a more assurance that it was working. And that's just kind of the nature of people. And if you think about that, it makes it a little easier to understand. Okay, so they've been pressing on this market all day. They've wanted that high. We've said that's what they're aiming for. They're now, what are they, just a half a point away? And what it's going to be above that, more than likely, you're going to have stops above that. And then we see if they don't get it, then you've got a poor high because you're so close. But we'll see what happens. But that's what they're doing right now. They're trying one more time in order to go after the all-time high. Okay, what kind of questions do we have out there?
Are you saying chunking is taking all of these observations and are you saying chunking is taking all of these observations as a whole, adding new info to the chunk as the market gives it?
Well, the first way I'm using it is just as you would back out of the garage in the morning. You know, it's you're taking a bunch of short-term information, and the first thing you're trying to do is get out of the garage. So in that case, chunking is pretty tightly reined. When I talk about, I think it's so important in the morning to see how the market starts. So in the morning, I'm talking about, you know, seeing what's going on, the many pieces very early on. But as the day goes on, yes, you're always chunking. You know, it is building. You're always saying, okay, this low is questionable. The volume, you're looking at the shape of the profile. You're trying to think about, you know, who are the competitors? Who are you competing against? But what you want to do is get to the point where that's more automatic. It's kind of like go from the garage to where you're taking a long, you know, say 100-mile drive. 100-mile drive, you know, you're continually chunking. In other words, you're continually learning the experience, you know, that you've gained in the past. I tell the story years ago that I avoided a very serious accident on the 405 north coming out of San Diego. And I was going up to LA. And, you know, it was 3 or 4 cars in front of me, very tight pack of cars, 3 or 4 cars in front of me. I just happened to catch that car come out of line a little bit into the next lane. And without doing any thinking about it, I had an automatic transmission. I shifted down. I cut on a 45-degree angle to the left, and I could clear the whole mess. When it was all over, there were 4 people killed in that accident. Again, that's a different form of chunking, but that's when you're driving, you're looking at all of those things. When you're trading, you're looking at all of those things. And it's difficult. It's difficult to keep them all in perspective and keep their importance balanced. It's like I say, you know, for example, driving 75 miles an hour on a drive pavement is one thing. Driving 75 miles an hour on ice is got another extreme. You know, driving 75 miles an hour on Sunday night going back down to Phoenix with the traffic and a lot of people been drinking, it's another thing. You make adjustments. The same thing in the market. You're constantly making adjustments as you take in new information. And
Jim,
it takes time to assimilate that. Yes.
No, thank you. Could you make today's profile bigger, please? Request from, okay, thank you. Now we see a 4-wide poor high, see it's gone by. Is there a point where it is unlikely for a poor high to be repaired the same day? We did see that if you look at July 4th, the holiday, it was a awfully strange looking profile, but unusual to be 4 wide. But I mean, even yesterday, or not, was it yesterday, we had 4 wide with the M period cleaning it up. So
On the
yeah,
4th,
July 4th, but that's a holiday.
Yeah. If the holiday, so that's like overnight trading. Poor highs and lows and overnight trading are very common because it's a different type of trader, mostly short-term trader, and they're looking at those references. Okay.
Okay. Let me just clean this up a little bit. I see very mechanical lows with the CDE periods, and it seems like 45 degrees with short risk. What's your thoughts?
I don't see a 45. I see balance.
Yeah, you need a little more rotation in
you need more rotation. You know, and that's why I keep saying that sometimes talking about, 45s and talking about things like firecracker effect are harmful because there's people think they're neat and they start looking for them everywhere. It's like one time we wrote an article on stealth short covering. You know, stealth short covering is one of the least important things you'll ever look for. However, it was the most highly demanded article we ever wrote. Sounded so sexy. Stealth short covering. Boy, I got to have that. And it was just such a minor piece. It happens so seldom, but it was sexy and people were looking for it. Okay, so now again, we've got a poor high again, easily within striking distance of the all-time high. But understand what I said earlier. The longer-term money or traders would rather sell on this side. They'd rather buy back their positions on the other side if there's price acceptance. So when you look at that, you've got to be very careful. So, oh boy, this is so slow. But you don't know what's waiting on the other side. Okay?
Yes. Okay. Give me a second.
Let me go back while you're looking for that.
Well, okay. I'm ready.
Go back, and I've written several times that even though there was an all-time high, it was a good all-time high because it had 2 ticks of excess. I've continually written it was nothing to write home about. And then we got this combination of poor highs, and I continually said chances are we're going back to that. I don't think the all-time high has been put in on the market. And that's what happened. Now the market went down. We also said, it's not uncommon when you get these poor highs and stuff, and even the questionable high, the all-time high, that all of a sudden you wake up one morning and the market's gone. And there it is. It happened the other day. You wake up and there they are. They're coming in and going for all this stuff. It's very hard. Sometimes it's very hard to understand how this happens. It's just you gain experience about that it does happen and how it happens. But this was a surprise. I didn't see this coming. The only thing that said this might be coming was the fact we got rejected the day before. When you get rejected at the bottom of trading range, like you did here, the potential upside objective becomes the opposite extreme of the trading range. Now that didn't always happen, but it's always a consideration. Okay.
When looking at open interest in pinning, I'm not sure about that term, but let's take it. How would the SPX index options compare to the E-mini S&P future options? I have often seen the SPX closing at a strike.
I don't know, and I don't look at open interest. I look at options open interest, but I don't know the answer to your question. It's very highly, there are a lot of small traders in the SPX, and trading, closing at strikes doesn't surprise me at all. Visible, they know where they are, but it's not something I've studied. It's not something I can give you an intelligent answer on.
Okay, well, please ask again if you have a more specific, question or something to follow up. And I mean, obviously the SPX doesn't have the overnight, so you have to negotiate the gap in the morning because it's not like you can go in overnight and adjust things. So I mean, just by its nature, the SPX and the SPY, it's not the 24-hour market.
Okay, so there we are. We're now 1 tick one tick from the all-time high. One tick from at least going up and getting the stops.
Okay. Okay, great. Let's see. Over the past week, we've had the market routinely get too long, but the liquidation breaks in the late afternoon have had no follow-through to the downside. How much strength does this give to this market, even though this 3-day rally has mostly been weekends traders?
Yeah, it's a good question. I'm not sure it gives strength to the rally. Okay, let me rephrase it. What it tells you is, it tells you that there's no real sellers. The only selling you've seen the last couple of days has been liquidation of short-term long positions. You haven't seen any selling by more serious money. So from that aspect, you have more confidence to be a buyer, because traders will, as I say, will do what works so it doesn't work anymore, and it's work to be a buyer. The only selling that we've seen in the last couple of days has been from traders that got too long in the day time frame. And once they were forced out of their positions, and the market continues on its merry way. So the information you take away from that is there's no selling. So I don't know how you equate that to the strength. You don't fight trends. You don't fight trends. And, the worst thing you do is say, well, and this is what I've done too many times with you. Oh, I look at, boy, that's a terrible looking day. That's a terrible looking day. I'm going short this market. And that can get it not only can, it has gotten very expensive. But it's one of these things of forming this opinion based upon the fact that the way it was going up wasn't very healthy. But when I finally realized that may be interesting, Jim, but unless you've got sellers, you're not going to make any money. So the real thing you need a combination of, once you get that liquidation, and you need more than daytime frame liquidation, and we haven't had that. So, but I don't use it to say the market is strong. I use it to say there's no sellers right in here. That can be a little different, because the buyers clearly aren't strong buyers. If they were strong buyers, people are going to buy it and put it away for a period of time. You're not going to have the kind of lows and the shapes that we've had. Mm-hmm. All right, other questions?
Well, when is your next fishing trip? And I don't want to get off topic because I know we have some other things, but I was thinking, Jim, it would be fun to post some pictures from our fishing in Key Largo. So maybe we'll make a page or something and have some pictures just for fun.
Okay.
Okay. So
I don't know when I'm going again. If I go again, it'll be sometime early fall, fishing probably the Klickitat River up in Washington State.
Okay, that sounds nice. You've said you prefer options because futures make you nervous. What specifically are you worried about?
Well, the volatility and the leverage, the volatility and the leverage can be a huge win or a loss. It works both ways on there, and that's and sometimes you just from a sensible standpoint, you come out of a trade that you maybe should have stayed in, just because you couldn't handle the risk. I'm going to guess there's a lot of people this morning that came out of when this break in D period. Probably some people that were long that came out of the market. I used it to take back a position. So, I can't take futures home overnight. I mean, I wouldn't sleep if I took futures home overnight. And you see so many times that the overnight trade can be so different than what we get in the day time frame. Okay.
Yes, and Jim, there's a question. In your opinion, would hedging with Nadex spreads work similarly to hedging with ES options? And just so people know, Nadex is an exchange for binary options with that, I guess it's like yes, no
I wouldn't.
options trading. So it's a different exchange just for binary options. So she's curious, can you use
Yeah,
hedging with the
I
Nadex
wouldn't consider it.
spreads?
I certainly wouldn't. Um, I mean, I'm not an expert on it, but the articles I've read are pretty negative. So I don't, I have no word on that, but everything I've read is pretty negative about how that works. Okay.
Okay, right now we have a double distribution, although I doubt it holds. Your thoughts on her assessment?
Well, it's been up all day. They've been up all day. They've been after the all-time high. They've gotten it. I don't know if it holds or not. I don't see anything that says it doesn't hold. Do I have confidence in this market? No, but I don't see anything that says it's not going to hold. I mean, if it doesn't hold, it doesn't hold. But I mean, the selling's been minor this morning. Some liquidation to rebalance things, but there's been nothing else.
Okay. What would a reversal / rejection of the all-time high look like?
Oh, I don't know. I mean, more than likely, you'd see sellers come in and you see the market pretty aggressively sell off, extend down through the through today's low and down to yesterday's low and through it. I mean, it would be pretty aggressive. You don't normally see that. A Friday afternoon, it's unlikely that people are going to come in to do that. You get misled. All of a sudden, you got some bad piece of news. This market is mostly short-term traders. You got some bad piece of news, knee-jerk reaction. I mean, you could see a very aggressive sell-off. It doesn't mean that it would be anything more than what we're looking at.
Okay. The SPYs also carry huge volume and are showing obvious visual profile of open and traded interest, telling the SPY close at 245 to 250. So between 2445 and 2450. Do you predict this because market is looking so narrow and something is helping to pin it here?
I don't predict. I look at, the market's narrow, but I take it a step at a time. The thing that keeps me alive is taking a step at a time. Right now, we are above the all-time high. We have a new all-time high in the market. We questioned the earlier all-time high because there was 2 ticks. There was no real excess on it. Okay, and now we're above that. And, my guess is that's got the potential to bring in, it's going to trigger some new buying. Probably. It's not a market I'm going to fade in here. And like I say, I take it a step at a time. If all of a sudden the sellers come in and they're aggressive, well, they did. But it's about, what is it? About 10, 11, 12, 1 o'clock. You got 3 hours left today? 3 hours, 15 minutes New York time.
Yep. 3 hours and 30 minutes. Yep.
Yeah, I mean, anything can happen, but we've seen no sign of selling in the last few days. If it came in here, then you handled it if it happens. But like I say, I don't predict things. That is usually first step towards disaster. This idea of taking it a step at a time. So you say, okay, if you went short, how would you monitor that for continuation? First, you have to leave an excess high. You got to get back down into the previous day's range. I mean, those are the kind of things that you take it a step at a time that you'd be looking at.
And I mean, just if I may, Jim, talking in theory and rejection, because it's such a big number that attracts the attention of all time frames, you'd see the excess most likely on, the longer term charts. Obviously, the monthly is going to take until next month to confirm any excess, but on the weekly or the daily, say we closed up there and then we open on Monday and it's much lower, and you've got this compelling excess tail that there was no overnight trade Sunday night that took out the pit session high, and you have a compelling daily and perhaps weekly excess. That's what it could look like. If we went back to the Trump election time, I think, the excess occurred in the overnight. But even looking at a bond chart, you can see when the bonds made all-time highs last year, there was compelling excess on your daily bars. I mean, these numbers, these levels are big, so it's not necessarily profile excess we're looking for.
Yeah, here's excess. I mean, this is a weekly excess, but there's what excess looks like, and it sold off pretty well.
And that was our high for the time, right? And
for the time, it was good for 1, 2, 3, 4, 5, 6 days. Then you went higher, but you just don't have any excess in here yet. So again, the worst thing you can do sometimes is lean into the wind. Do I do it? Yes, I do. But if you're going to lean into the wind, you got to be right, and you got to be right very quickly.
Yeah, I was just trying to give her an idea of what it, could look like or would look like if that happened. And you can look back on charts and get a sense of the end of one auction and the beginning of another. And it's usually pretty compelling excess on a bar chart.
See, this auction ended the first time, was not compelling.
Yes, even though on a daily bar it looks compelling, right? You look at the fine.
When you look at this, and so did the market go down a bit? Yeah, it did. It went down, but we kept writing. Probably not highs, probably not in, etc. And so it kept me from getting really short, kept me from getting really negative, and sure enough, now the market's back there. So I mean, it's been a long time. When did we make this high? We made this high on 6/19. Today is 7/14, almost a month ago. And I've probably written about that 20 times in the, probably 8 or 9 times. But it was something that I continually kept in front of me. So I had, it kept the perspective. Again, when I start at the monthly, the weekly, the daily, then I go to the profiles. And I'm looking and I'm trying to, when I start my report at night, I'm trying to keep some perspective of what's going on in the market overall. And, how many times have I written about that? And I'm sure some people thought, I'm tired of hearing that. And here we are back. You get tired of hearing it, means you put it out of your mind. I can almost guarantee we're going to go back to. And we did, and then we combine other information. We combined with that was a series of poor and weak highs, which just reinforced what was going on. So what we were getting was liquidation of trading positions, but we weren't getting, really good new money selling. While we're at it, when you make new highs, I don't know how many times, let me go back here for a second. The market had made, prior to that time, I guess my charts don't go back well enough. I'm sorry, let me go. Okay, it made a new high right here. That was before this high.
On
made
June
a new
9th.
high, June 9th. The market broke. I remember this break because I actually caught this break, but there was no excess. So the chances of this continuing very much were slow, were slim. So you got some liquidation, and then you came up and made a new high. So the first thing, and let me see before that, that was the first one in a long time. But down here, I think would have been a new high at that point in May, and then the market, came down and it made a new high. What I'm saying is it's rare that a market makes a new high and the first time and then heads in the other direction. That is a rarity. Generally, one new high begets more new highs. Now, obviously, at some point in time, that's not going to happen, right? But overall, one new high very often begets another new high. It's just something to keep in mind because sometimes people have a tendency to say, oh, new high, and it comes down a little bit. They think they're seeing the greatest trade in the greatest trade in the world, and they get short, and then they fall in love with their short trade. And and then the more it works for them, the more in love they become with it, and the heavier their short position gets, and then the market comes back and wipes them out. So again, that is, we a lot of times we're greedy. Oh boy, we got a new high. We got to get it. Failed at that new high. We got to get short. We're going to make a lot of money on this trade, and sometimes you will, but you have to keep in perspective. Look at the quality of the high. Understand it. A lot of times new highs, take the trading systems, they beget more new highs.
Yes.
Okay.
Yeah. I remember the breakout from 2417 the first time a bit ago, and it was very powerful and didn't look back for the rest of the day. But that was much earlier in the day, not during the lunch hour. I'm wondering if you are more suspect of this kind of break at this time of day. It will be interesting to see how it behaves the rest of the day.
Yeah, not all traders are in New York. It's 9:52 here. I haven't had lunch yet. There's traders from all over the world. Sometimes it's bedtime in other places. So I do understand that there's a tendency for trading to slow down during the lunch hour. But if there's really something going on, traders are available any moment of the time. I think a guy I worked with years ago, flying his Falcon 50, he had, I think, 27 phone numbers he could be reached at. So traders traders can be reached if there's something meaningful going on.
Hi, I'm sorry, my phone rang. Be right there, Mike. Jim often talks about not seeing elongation. Can he explain what elongation looks like to him? Thanks.
This is not. So I mean, it becomes one of degree. We haven't had a good elongated. Here's, you may say this is elongated, but remember, I was pointing out the point of control didn't go lower. We got the 45. So yeah, it's more elongated, but it's more than that. When you look in here, this said, no, this is all emotional money, and it came back. So again, it's not simply elongated. You have to take it. You have to take the pieces. If you get a healthy market that's going directionally, it may only get 4 or 5 wide, and it's just kind of steady throughout the day. You don't want it to get overly carried away, and you don't want it too thin. You don't want it too truncated. But I can tell you these are not. And that question always comes up, and it's not it's a question you learn. It's an answer you learn to via experience. And the first thing to say, this is not. And like I say, if it gets elongated, it'd be 4 or 5 wide, and then it goes again, and it's got some symmetry to it. Okay. What do we got?
Yeah. Hold on one sec, Jim. Okay. The example that Jim gave overnight, 3 periods high is a weak high, but the sequence of events is to first a liquidation before taking that high. So today now, and this is a while back, 3 periods high, then maybe first liquidation, then come back and take that weak high?
Yeah.
See, now he asked this before it happened, so it's...
Well, I mean, no, this was in deep period. It broke in deep period. and they got some selling. Again, the momentum players came in right there.
But it was the high after that CDE and then F period. You know, you didn't really get the liquidation first.
Yeah, that's all you had. Yeah, you know, there's not a whole lot of stuff to write home about in that thing. It's just it always happens a little bit differently. So sometimes you're trying to look for a pattern. You're trying to say what's it's actually going to look like, and it's always different. It's always different. And you know, you just gain experience over time. I know that doesn't sound, you know, very sexy, but that's in fact what does happen.
Yeah, I mean, all trends are up, so it does make it tougher because your trade location is, you know, if you want to participate in the move up, you just kind of put the long on, and then just stay with it. But it's more difficult. Okay. Well, we got to that question. If we didn't get that the way you needed, Ehab, yes, please send an email. In the past, you said that to stay in this business, you need to go with breakouts. But it sounds like you are very skeptical of this move higher. You're giving me cognitive dissonance. We ask all questions and comments here. We don't filter too much, but thank you, James.
This breakout happens late on a Friday afternoon, all-time high. I don't know there's anything wrong with going with this breakout, as long as you know how to manage the trade. It is an upside. It is an upside breakout, and you know, and you go with those breakouts, but you have to know how to manage the trade for continuation. I mean, that's really the key that you're after. So, but let's examine what's happened here. If it's a good upside breakout, it's going to be good for some period of time. And nothing says you have to go today. And I'm not against it if you go today. But what you understand, what did you get right now? You had trouble getting up there. You finally got it, and you got stops. You know, very consistent in what you would expect to do. You'd expect to get stops. And you probably got two types of stops. Remember we talked about the other day. You get those stops that were protective, those that were short and had a protective stop there if the market went higher. And you have another level of stops, which are new entry level stops. So you had people with buy stops to enter a trade. They weren't protective. They were entry. They buy stops to get into the market if the market broke out to the upside. So the first step you're dealing with is the stops. And then the stops get hit, and they trigger all kind of enthusiasm. Then you got to wait and see what happens after those stops are you know, dealt with. And now they've been pretty well dealt with, and we see what happens. I look at the clock. We're going to change time period in a minute, and we're going to see what do we have. Do we get any follow-through buying, or was it just the stops? And maybe that's all the traders are after. I mean, there's no one single way. I always look at what led to it. So in one way, you want to go with the breakout, but remember, I always have a choice to say, that's nice, but I'm not going to do this one. And you know, and that's a choice you make. I'm not going with this one, but I'll take a look next week and I'll see what happens. I'm just not going to go on a Friday afternoon.
Yeah.
So just for an update, I had the calls. I sold the calls. Sold the calls at 4. It kind of locks in a loss. I mean, it locks in a loss, but I just took the calls off, stepped aside, and come back another day. So my average cost, you sell them at $4, you're getting $200 a piece. I think my average cost on getting everything was probably three and a half. I don't remember, exactly, but probably a small loss of scratch. I'd have to look exactly, but you take advantage when it comes. I wanted it to go early, but it did come, and I said, okay, I was positioned for the breakout. If it happened, I'm out of the trade. I'm flat. I've still got the other stuff that's going to expire worthless. Okay, other issues.
Yeah, and also, to just follow up on your comment that I'm not going to participate, I remember, when I would get frustrated missing things or not participating, and you said really it's a sign of maturity as a trader when you can recognize what trade you feel comfortable with and not getting particularly agitated because something is going on that you're not a part of. It's really just a maturity issue as a trader. And I always remembered that and realized, wow, I'm pretty immature. But, I still can appreciate it, and over time have peace with what I do. And, obviously we're not going to be a part of every move. And I know we get frustrated with things we see. Geez, why didn't I take that? Well, if it was something we wrote down, it was a scenario, and we didn't follow through with our preparation, that's a little different animal than something that maybe developed intraday that we just didn't have the confidence in and we stepped aside. I mean, you talk about that guy, Bruce Kovner. I think Bruce was a cab driver that got his first trading account using a cash advance on a credit card, and he's become this super trader. And you said that Bruce would stay out of a market for months. If he didn't like it or didn't feel like he felt comfortable, he's the hell with it. I'm not doing it.
That's right. He wasn't gonna do it.
And I think he's a billionaire now, right, with his account and his trading, and I don't know what he has, but he's been tremendously successful.
I think he's gotten way out of. I think he's liquidated as he's gotten older. But money that people that had their money managed by Bruce, their concern every year was that he kept giving money back to people because it was getting too large, too hard to manage. Very, 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 very smart in there. And I remember when he first started was with, I think it was called Commodity Corp out of Princeton. And he grew from there. But it's Julia said it better than I do. It's this really idea of trading maturity. So anyhow, Julia, I know you've got a meeting. It's 1 o'clock. Unless we've got a couple more questions.
Yeah, well, let me just quickly try and get through here. If we could answer just a question. Well, this is not a question for Jim, more a comment in support of the other trader. I don't know that there's anything wrong with going with this breakout, but Jim has been strongly pessimistic of the buy side for a few days, and today has been talking about the weakness since 15 minutes past the open. It's causing me to get cognitive dissonance too. I even exited an early long position when it failed to find buyers above the 50 quarter on the second try.
Okay, put some pieces together. Remember what I said earlier, not uncommon for bigger traders to do what? Sell on this side and then buy on the other side. That can be very confusing. If this is a legitimate breakout, more than likely you're going to have plenty of time in the market. I think we hit stops early on, both type of stops, but there has been no sellers have emerged in this market. There's no sign of selling. You got the stops and you got people still buying. Again, I say you can go with these breakouts, even though I elected not to. You can go with these breakouts as long as you know how to manage it. Okay, if you go with this breakout, what would you do to monitor for continuation? Okay, one, you don't want to see a big selling tail. 2, you don't want to see the market back within this previous range, down below, down below the, call it the 24.4750 level, which we were using. Again, that's how you monitor for continuation. Now you're going to look at volume. You're going to look at shape. So again, I have missed a lot of opportunities because I didn't go with breakouts like this. But again, I have to make my personal choice. I haven't liked the way this market went up and everything, and I just elect to stay out. But remember, over the years, I have missed tremendous opportunities. And I've just gotten to the point anymore, if I go into something that I'm not terribly comfortable with, I have a tendency not to manage it well. So look here, it is a breakout, and there's no sign, there's no selling tail at this point. And, you sit there and say, okay, let's see what happens.
Yeah, and I will say it's difficult, being on these and giving your best, but sometimes just not knowing and causing cognitive, someone said Dalton, and he was joking, but, just a play on words. But if you look at the first article on the trading articles page at the premium content page, it says protecting yourself. And it's an article on protecting yourself against Jim and other people and talking heads, you hear. How do you stay true to yourself while also having an open mind to learning from others? So it is something that requires, some thought or reflection. But we appreciate your comments, and Jim, I think your answers are right in there and fair. It's just the way it is.
Here's a new high. Here's a new high. Up here, there's a breakout. I didn't go with that breakout. I didn't like the structure. Okay, and you see what the market did, a little correction before it went back there. Just a personal choice. But it was an upside breakout. It was an upside breakout. Once it traded above the C period high, so following the breakout, I'm looking at the thing, and it's just, I don't see any new money coming in, and I elected not to go with the high. It's a personal choice, and there's something about dealing with odds. Sometimes you win, and sometimes you lose, but odds are just that. They're not 100%. They're not 100%. So this one, matter of fact, not only did I not go with this one, I think we were doing I don't know if this first session or anything, but we got a little value area trend to the downside, and I caught this little trend. And then I think we said down here, if I remember, you want to see if the value area trend ends, and that was kind of a clue. But I say it over and over again. Everything's a very personal choice of what you do in these markets. Okay, it's up to you, Julia. I know you've got a meeting. Well, I'll take whatever questions. I don't have any place to go.
Yeah,
it's up to you.
I can go not much longer, everyone, and I'm sorry. Just something I have scheduled, and my cat is sick, actually, so I have this vet appointment, and I just need to, obviously take care of life work, life business. Very quickly, Jim, now with the HTPO, there is no longer any excess. Is this a sign that today can go even higher? And a second comment, if I could please address that, but is the all-time high now support? So both questions, if you could just... Yeah.
The all-time, the breakout level for momentum traders is now support. That's exactly it's exactly how they do.
We saw it this morning in B period. It's classic momentum buying.
Yes.
And then as far as the poor high that's languishing now, that's obviously, she's asking, is this a sign that the market can go even higher?
Yeah, there's no completion to it, but understand as we get later, there's a lot of longs in here, and again, you've got to get away from just thinking in terms of price. These are not strong longs in here. They're not strong longs. The market broke up and you got the stops hit. Stops bring in other people. Excuse me, I'm sorry. You got to see what the rest of this day brings in here. It is a breakout right now. This is support. Coming down to this level is support. The longs from today, nobody's had a chance to get out of the market yet. Again, I say you take it a step at a time. Right now we have an upside breakout. Remember, we've been writing, all trends are up. So you don't fight the trends. You don't fight the trends. It doesn't mean that you have to be a participant as it gets later and later in the trend. That's the thing. Personal choice is very important.
Mm-hmm. And Jim, one last question, everyone. I have found it difficult to enter trades going with momentum traders, even though I'm able to recognize when the market is dominated by them. I feel like it's a negative connotation and it gives me dissonance. What should I do to get around this?
It's a very fair comment. And one of the things, as I said, after I retired, and I went to Thailand, and things just popped into my mind. And one of the things that popped into my mind, and I wasn't trying to deliberately do any soul searching or anything else. I was just relaxed, and all of a sudden, it came, and I said, I haven't fairly covered momentum trading. I haven't fairly covered, and I think I've given too much of a bias towards momentum trading. And I came back, and one of the hallmarks of, when we came back and did these 2 mastery series, you have heard me consistently talk about momentum traders. And I may give you a negative connotation because it's late in the season for the rally, from with the structure and everything else. But again, come back and say, this is what they're doing. This is what they're doing. This morning they were trying to get they bought off of the prior high. They came back and did it in D period. So they're there. So one thing is not to fight them, but again, if you can go with them if you know how to manage the trade. And that's what I keep coming back to, is managing the trade, is monitoring for continuation. They come back here and you got your stop someplace down below yesterday's high. But it's not, believe me, it's not easy. And your feeling is a very fair feeling. Sometimes we do things mechanically. We say, okay, we're going with the breakout, we're going with it mechanically, and we're going to put mechanical stops in the market. But we're going to get on board and we're going to see what happens from there.
Yes.
But I'm probably responsible for that, and I'm sorry for it. But I came back, I'm trying to cover it. Early on, the other day I was pretty positive. We left an excess low down here, and pretty important concept. And, the momentum buyers were there again, and they're there again. I didn't like the follow through. I would like to have seen more elongation and more volume to tell me that I had more. I wanted to see more than just momentum buyers in the market in order to have confidence. And I haven't seen that. So sorry if I gave you that, but again, manage the trades for continuation.
And our friend from Thailand who you met over there, he said Thailand has a tendency to have that effect on people. That's funny. And
actually, it was sitting on their porch. It was so relaxing and allowed me to think. And we did look at a couple markets one time.
Mm-hmm.
But we were maybe it's the fact that we were talking markets a little bit. We weren't going overboard with it, and they showed me a wonderful time. But I did, I was relaxed, and I did reflect on things. Okay.
Okay, great, Jim. Thank you. And thank you, everyone, for the questions and participation. We'll add another additional webinar during the week for the more, beginner questions and that sort of thing. Obviously, we encourage you to take command of your education and read articles and continue to mine the site, the training site and the member site to take initiative and learn, but we can take some time with you as well to answer questions. So maybe we'll do another one, and we've got Yellen and another, but we'll work that out with you. So thank you, everyone, for being here and the great questions. And if we didn't get to your question, I'm sorry about that, but another time it will present itself. So thank you, and have a great weekend, and we'll be back with you on webinar at 9 a.m. Monday morning, reports to come Sunday and Monday morning before we get on the webinar Monday morning. So have a great weekend, and thank you for the first week. This has been a really encouraging beginning for us, so we appreciate it. And Jim, thank you from everyone and me for
Okay, thanks.
that. Okay, thank you. Take care, everyone. We'll see you soon. Bye-bye.